Hello and a very good evening, everyone. My name is Lukman from Kenanga Futures, and I'm gonna be your host for tonight's webinar. FYI, tonight's session is a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. In view of this, currently there is an ongoing campaign from now till end of October to earn up to 28% cashback when you trade with us on selected micro and e-mini futures contracts. Should you wish to find out more information, please visit our website www.kenangafutures.com.my. Please take note that futures and options trading involve substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes, and Kenanga Futures accepts no liability whatsoever for any direct or consequential loss arising from any use of content of this webinar. So tonight we have Mr. Wong Kon, an investment and trading strategist, and he founded Wikipedia Private Limited, a firm that provide market insights and educational services to financial institutions. He started as an apprentice on the trading floor of Singapore International Monetary Exchange. Since then, he had been a floor trader, financial dealer, and an active practitioner in the securities and derivatives market, with more than 25 years of trading experience in the market. So, without further ado, I would like to invite Mr. Konau to speak. Over to you, Mr. Konau.
Yeah, so thanks, Lokman. Let me just put up my slides. I realized that when I put up myself, I don't see my slides. So I think I'll just remove myself. Let me just try that again. Okay, yeah, I think I could see my slide right now. Okay, I think first of all, I want to thank you, Kenanga Futures and CME for having me to speak about tonight's topic. I think the last time that I have with Kenanga was, I just checked, was August last year, so it's more than a year. So just going to give you a quick recap what I shared in last year, August, and is quite related to what I'm going to share tonight. So the title here today is that why is gold not trending higher with inflation? And we all recognize that inflation is so real, not just happened to Asia, but all over the world. So thank you, Kenanga Futures and CME, and also want to thank you, the audience that is tuning in at home on the office for today's topic. So let me just quickly go through what we are going to share tonight. And basically there are two parts to it. So tonight I'm going to build on the fundamental, which is the part one of this series, where we're going to discuss about why the gold futures is not trending higher. Of course, what I advocate is that gold futures or gold market will be higher in time to come. It is not if whether it will come or not, it is when it will come. Okay, so it's not a question about whether you will trend higher. It is a question of when you trend higher. So I mean, why do I have the conviction? So of course, then we're going to discuss about the fundamental reason. So once you can have the fundamental reason to back you up, the conviction that I have, then it is not a question of if, it's a question of when. Then for today, I'm going to discover about the fundamental reason. We're going to talk about CPI as well. So 2 weeks time, the same day, which is on a Wednesday, I'm going to discover about the technical strategy about getting into the gold market. So just very quick run through. So tonight I'm going to discuss about fundamentals. So the first part, I'm going to talk about gold, the fundamental reason why gold is a currency, is no longer just metal. Then after, going to move on to we're going to discuss about the US dollars. Yeah, so how is gold related to US dollars, and how is gold related to this inflation, and how is gold related to interest rate? So once you understand these three factors, US dollars, inflation, and interest rate, I would say that you are good as an investor, as a trader, to understand about the gold main trend or the main direction to come in the very near future. So just a very quick update about myself. So basically, I specialize in behavior science. What is behavior science means that it's market psychology in identifying macro trend and forensic price behavior. So we're going to study about, you're going to see how I use that. And it's not just for me, but I hope that throughout the session, the next 1 hour that we have, I think the last 15 minutes, we're going to have a time of Q&A. Do submit your questions along the timeline. And I think Lokman will take on all the questions and I'll try to reply all of them. And you're going to see a lot of demonstration how I look at the forensic price behavior between the different markets. And I would say that I hope that that will be an inspiration that it's not just I can do it, but I would say that once you understand that market do connects, that you can do it as well. Okay. Now, disclaimer is that what presented here is not a recommendation, so please consult your licensed broker, in this case, of course, Kenanga Futures. And my mission is to create lateral thinking skill for every investor and traders, knowing when to take a calculated risk with market uncertainty and definitely a bolder risk when market opportunity arises. There you're going to see how I entered into the gold position at the beginning of this week, why I entered into a gold position. Now, before that, just want to give a quick thanks to my sponsor that I'm just so thankful that they have launched this micro e-mini futures, the index equity in 2019, just ahead of about half year ahead of the pandemic, where it started in 2020. And that created a platform for many traders and investors to use that as a hedge, because then there was only e-mini S&P, and those became very costly, expensive, because as the indices grew, Dow Jones grew, Nasdaq grew, it became very expensive to have them. So I'm so thankful that they have the micro e-mini futures that birthed out in 2019 that enable myself and I believe many other traders to participate in hedging and trading into this micro e-mini index futures. And just to give you some highlight about which are the most traded ones, and these contracts are the most successful that Chicago Mercantile Exchange ever launched. And you could see that the one that's heavily traded, of course, is Nasdaq, and followed by S&P. Then we have Dow Jones and Russell has been gaining some momentum lately as well. And this is just a demonstration since the launch in 2019. And you could see that how it became so useful. Basically, in March 2020, that's where pandemic hit US big time. And that's how the market participant traders and investors use it to hedge. You could see that how skewed the volume have picked up tremendously from then until today. Yeah. And there's something that I think is so interesting that I'm very proud of being an Asian traders, including yourself, is that this part, it represents the segment about, you could see that between 47% is by NQ, that means Nasdaq volume. And then we have 42% the S&P volume. Yeah, but look at Asia, this APAC means that Asia, the contributor of the volume that we have is 69%. We like trading into the Nasdaq. Yeah, you could do a comparison that I think the Asian traders were really into technology, stock composition. Of course, we are trading an index futures. So there's something that I kind of find that is very interesting. Of course, between the Dow Jones and Russell is about the same compared to the bigger market. But Asian traders, we enjoy trading the NQ, which is the Nasdaq market. So I think about 1 year later, where because of the successful micro e-mini indices that CME enjoy, they also launched the options for those that are interested in option trading. Yes, it's available and the volume is fantastic. There's liquidity as well. So at the moment, there's micro e-mini S&P options available, and also micro e-mini Nasdaq that's available. Okay, so that's the last slide for CME. Just want to bring you to your attention here is that there's a lot of free education. That there's this one that launched about more than a year ago, fresh from Trading Room, where I enjoy receiving email from them every 2 weeks. That what they have here is stated here is that the expert analysis helping you turn market information into insights, delivery directly to your inbox twice a month. So I just have my latest one about 1.5 weeks ago. The title is already issued 28. The title is Understanding Your Cognitive Bias in the Much Changing Investment Paradigm. It's a very interesting issue. So it's free. So what you could do is that you can just take a picture and QR code scan, and then you can register for yourself, and you will receive the next report, I think, pretty soon in the next few days. Okay, so I just give you a few seconds for you to take a picture, then we'll move on. Okay. Now, this is just about 5 minutes before the session start. I just want to know when was the last time that I have speak with Kenanga Futures. That was August 2020, 2021, so exactly more than a year. So I did mention about the topic back then was trading psychology, and at the end I gave analysis about the broader market and talk about the US market, and the whole market here is that I'm suspecting that we have a gray rhino situation. So what's a gray rhino situation compared to a black swan? Black swan is something that we have no control. It happened suddenly and overnight, and it caught everybody by surprise, right? So gray rhino situation was, remember, that was August 2021, and before the market drop, and the market start dropping in December and January when Jerome Powell said that inflation is no longer transitory, and that was on the 14th December 2021. So I remember the date very clearly because I'm waiting for that to happen. Why? Because I suspect there was a gray rhino event, and that we discussed about that in August last year with Kenanga Futures. And what is gray rhino? Gray rhino means that we know that there's an existing problem, that you're facing this huge, gigantic rhino, and you don't face them, because if you face them, if you going to run away, they will charge against you, and definitely you're not going to outrun them. So it means that if there's a problem, we got to face it. Don't avoid it, because gray rhino is an issue. So what we discussed here was this, that was captured on the 24th of August 2021, right? So we discover about the let me just move here, that then was the Dow Jones was around a high at about 35,000, 36,000. So I'm expecting the market to drop because the market getting a bit too greedy. That's what we discussed. And so what happened here, I just want to give you a recap, and everything is coming to in place. So that's what we discovered last year with Kenanga Futures. But today we're going to talk about gold. And I just want to bring you some light in darkness. It means that yes, inflation likely going to stay. Interest rate, it seems that it's going to continue to move up, but it's not all gloom and doom. You have to understand that market is very dynamic. One market may be down and another market may be up. And what are they? They are the commodities market, the yield market, and commodities market. I think CME have a lot of wide range of commodity market. Gold is one of them, meat is one of them, and you can always talk to Kenanga Futures. They will introduce you to all of them. But let's be on the fundamental right now about gold. Now, first part is that gold, I want you to bring the attention here is that gold is no longer just a metal. It's no longer just a precious metal. You have to view gold as a currency. Now, what do I mean by you have to view gold as a currency is this. Now, let me just bring you to understanding that currency is always a pair. It's always two sides. When I say I want to buy dollar ringgit, it means that I'm seeing that in the future, dollar to move up and ringgit to come off. But if I say I want to sell short, I'm selling short the dollar ringgit right now, it means that in future, I'm suspecting the dollar to come down and ringgit to go up. So that's a currency pair, right? So a currency is just functioned by a pair, yeah. And it's always one party move up, one party move down. Now, next is gold. Now, gold during the era, because the US dollars is tied to gold, and if gold move up, US dollars move up because gold is equal to US dollars. Now, even after World War, and we saw that in Bretton Woods, although it's not 100% anymore, but there's still an element of gold tied to US dollars. It means that when US dollars go up or gold move up, US dollars will move up. So similarly, when gold come down, US dollars will come down. But something happened after 1971 when Nixon said that going to remove the gold standard, and that became gold is no longer equal to US dollar. So I would like to say that if gold move up and US dollars will come down. So similarly, it's the flip side the other way. So later on, we're going to do some case study to let you understand the point here. So you just have to understand that gold is also a currency pair. Now, when I say currency pair, against what? Because I say earlier that currency is always a pair. Now, gold is a currency pair against the US dollars. Now, let's study about this. Okay, so it means that when gold move up, US dollars will come down. And now notice my grammar, I say that when gold move up, US dollars will come down. I didn't say that likely to come down, because to me that became a fact that gold is a currency. So based on my opinion, it became a fact that gold is a currency pair against the US dollars. You may want to note this down, that gold is a currency pair against the US dollars. Now let's study about this very interesting behavior. I just prepared this about 1.5 weeks ago, or less than that, so it's still very current. Now you could see that it started in 2001 as I prepared. Now when dollar index represent the basket against, I think, about 6 currency, yeah, about 6 currency, their major trading partners. Now, so dollar index is one of the index best measure the strength and weakness of the US dollars. That we could see that from 2001 all the way to between about 2008 to 2011. So basically the US dollars just range bound about here. But we could see that from this period to here, the market, the US dollars was down 66%. So remember that gold is a currency pair. When US dollars come down and gold move up. Now, we could see that in the same period from 2001 to about 2011, the gold has appreciated by 652%, whereas the US dollars depreciated by 66%. So it's a reverse, right? Now let's look at the next slide here. So from about 2008 to 2017, so you could see that there was an appreciation, that US dollars have moved up, is up 46%. And then the gold has come down during the same period, about 2011 to 2015. Yeah, so this at the end of 2015, this is at the beginning of 2017. So it's about that, during that, around the same period. After that, you can see the market kind of range bound. But you could see that as US dollars appreciate, the gold depreciate about the same value, or it is the same value. Okay. Now, then after that, the US dollars range bound for a while, until recent years when US dollars started to hike interest rate. Of course, that have brought some good news. But before that, I think gold did come down. It range bound, yes, it did range bound, but from this 2017 to 2021, it was down 20%. Now notice that when it was down 20%, what happened to gold? Gold moved up by 100%. That was about 1,000 US dollars to about 2,000 US dollars. So gold was up by 100%. Now, then when somewhere around last year or before the US hiked the interest rate this year, but last year you could see that the inflation number was very strong, and that's the way the market, that they anticipate that they will hike interest rate and gold start to, or rather US dollars start to appreciate. You could see that the US dollars have moved up by 28%, and similarly the gold have come down by 21%. Okay, now I want to take an observation about certain characteristic. Now it's beyond that. We recognize that gold is a currency pair against the US dollars, because I think from this demonstration, we're quite convinced that when gold move up, US dollars come down. When gold come down, US dollars move up. So gold is one of the best representation of a currency against the US dollars, because there's some history behind it. Now, there's a characteristic I want to recognize here, which it got me very excited. Can you see what's the characteristic? Now, the characteristic is this. Do you realize that when US dollars move down, gold move up a lot? Okay. Now, when US dollars move up, that gold move down in the same weighting. Okay. Now, when US dollars move down 20%, and gold move up a lot more, 5 times more. Okay, do you realize that each time when US dollars move down, the gold move up even more? And when US dollars move up this time round, up 28%, then gold move down by about the same magnitude as well. So these are the characteristics. So it got me very excited when US dollars is down, gold move up a lot. Of course, there's a reason behind it, but maybe I will take your question during the Q&A. Why is it so? Okay, so we understand this relationship, and I just want to point to you that if we're going to benchmark at 2001, and I'm not going to benchmark in year 1970 because I think it'll be doing an unjust, it's not doing a justice to the dollar, because 1970 the gold was at $35. If I use $35 and the recent all-time high, which is about 2000, I think gold definitely is a champion. Yeah, but let's look at, since after the dot-com crash, I think the super bull market started all over the world. That was after the dot-com crash. And then 2001, you could see that the COMEX gold was about 255, and the recent all-time high at about 2000, coming close to about 2001. So it's up by 559%. But if you look at 2001 to recent all-time high, the dollar index is down, still down at about 32%. So gold, to me, is an inflationary hedge assets. Now, a lot of market watchers, they do not understand. So when I read about what they've written, I just could not believe it, because they say that gold, there's no relation about inflation hedge, because I think they are looking at a very smaller time frame, day-to-day operation, and they fail to see a bigger picture. So let me just share with you the next slide. I think that's Dow Jones. Okay, I think that's a better representation about inflation hedge, right? So you could see that from 2000, after dot-com crash, the Dow Jones have up by 413%, and gold, in fact, of course, during this period, there's also inflation as well, that we could see that gold has been up by 717%. If I'm going to take the recent low, somewhere after dot-com crash, and the recent all-time high for both, gold is still a champion, whether you're going to compare it to stocks or going to compare to US dollars. I will come back to the US dollars again very, very shortly. Okay, so yeah, we'll leave the rest of the question during the Q&A, but of course, along the timeline, you can always submit your question. So we're going to have time for Q&A later on. Now, so has the US dollars appreciated more than it should be? Now, as the Fed have raised the interest rate, so naturally, when they raise the interest rate, people will start to find that if I'm going to sell, in my case, in Singapore, I'm going to sell my Sing dollars, and going to buy US dollars and park my fixed D in the US dollars, I'm going to earn more interest. Yes, it's true. So now when the Fed increased the interest rate, why the US dollars will appreciate is part of the main reason is investor will find safe haven. For example, I'll sell my Sing dollars, buy into US dollars, and put in the fixed D in the US dollars. That's one of the main reasons why US dollars have appreciated over this year, when the Fed increased the interest rate. Now, so has the US dollars appreciated much more than what it should be? Now, let's look at the timeline in 2021. So earlier we studied a bit, quite a bit about in year 2021. Now, in 2021, the Fed fund rate, it was about 0.25%. And the recent high, it was about 3.25%. So indeed, the interest rate have moved up over this period from, 2021. Wait, was that? Okay, anyway, it should be in 2000, year 2000. I think I make a mistake here. In year all the way back to 2000. Yeah, so I think I make a mistake because I prepared this during the afternoon. If you trace back to year 2000, the interest rate was around 0.25 to about 0.5% as well. Okay, so from year 2000 all the way here, the interest rate have moved up. Okay, so this one I make a mistake, so please do verify. So somewhere around 2001, the interest rate was also about about this period. Now, so it means that the market have moved up. Yeah, because this is 2001, right? Yes. So sorry, I just recovered from a flu and a sore throat. It's not COVID, but got infected by my son. But I just want to share with you that then there was an interest rate. It was around the low. And we could see that the dollar, earlier I explained to you that when the interest rate on the rise, it will bring attributes to US dollars, because mainly investor will sell their currency and buy US dollars. And so did this rise in interest rate add much value to US dollars? It seems like it, but really not much, because over this period, you can see that the US dollar is still down 32%, but the gold has appreciated by 539%. So I would say that the gold is one of the best, I would say the best inflationary hedge assets, in my opinion. That's what I observe. Yeah. So don't miss that out. And let me just move on to the next one, where I think all of us are concerned. The number one question in our mind that we keep asking ourselves is this inflation going to stop? It's not just in Singapore, but in Malaysia as well and all over the world. Is this inflation is going to stop? And I'm going to share with you this, what happened here. It may seem like a negative news, but I think that's the whole idea about then where to look at, what market to look at if inflation is going to be continue to move up. Now, let me share with you this interesting slide here. This is called the Consumer Price Index. Consumer Price Index, it means it is the best studies for inflation. And I can tell that the Fed is watching this like a hawk right now, every day, every week, every month on this index. Now, so I captured this from this website called FRED. And but I just want you to focus on the blue line, because the blue line will include the food and oil. And food and oil is the most precious to many of us today. Okay, so we look at the blue line. But I also want you to look at the history of what happened here in 1980. Now, in 1980, the inflation, the CPI, was close to about 14%. So what made this inflation number come down so quickly to about near zero? It was then the federal chairman called Paul Volcker, that he tried a strategy that no one did before in the past. That he says, since the inflation is at 14%, I will up my interest rate beyond the CPI, which is 14%. So he upped to about 20%, close to about 20%, and that really brought the whole market down. But of course, then the president, Jimmy Carter, also lost his job, so he didn't serve the 2 term. So the first term he was out because of this, but it kind of saved the whole US economy. So so that was back then. But I'm going to, I'm going to blanco this out. Okay, and let's study about this more intricately. Here is that let's observe that since what he did, he upped the interest rate to about 20%, it came all the way down. And over the last 40 years, mainly the whole market enjoyed peace and low inflation that you could see here. That over the last 40 years, whether it's an increase of money supply, whether it's a QE, I think most of us are very familiar with QE, but all these we know is printing of money, right? Yeah, there's no secret to it. So as long as there's printing of money, we also know that it's by fact that once money is printed, this money will cause dilution. Now, it's not just US, but all over the world. And when you print the money, you'll cause your currency, your nation currency, to be diluted. Once your currency to be diluted, it will cause inflation. I didn't say it likely to cause inflation. It will cause inflation. So that's the fact, how it works. That's why we feel that the inflation is happening all over the world here, because it's not just United States printing money, but many nations and their central bank are printing money. There's different term you can call it, whether it's a money supply, QE, or whatever, but all is printing of money. But I would say that Fed is a leader, and over the last 40 years, you could see that how well, in spite of all this money supply, QE, they have managed to keep the inflation at about average line. I draw this average line about 3%. So they're good. They're just doing an amazing job. But I would say that the COVID-19, the war, that you could see that before 2020, inflation is well under control, but there's this undercurrent, that this problem waiting to surface. It's just like a switch, right? Just waiting for event. So I would say that this COVID-19 and this war that's happening in Russia and Ukraine is just a switch that turned on the existing undercurrent, which is a dilution of currency all over the world, because there is an inflation that's going on, but being suppressed now, managed by most of the central bank. But this switch has been turned on. Now I can tell that even the virus is over, that means completely kill off, which you know is not possible, and even there's no more Ukraine and Russia war, but the inflation is not going to come down because the switch has already turned on. So unlikely it will come down. Now, the next slide I'm going to share with you is very interesting here is that I want to look at this. I prepared this in color code. In blue, it represents that since February and March 2021, it's still below 3%. Now, something happened after that. The green zone is that April 2021. And for the first time, it broke above 3%. Now, you got to see that 3% over the last 40 years is like a safety zone, right? Now, but April 2021, something have changed. It broke above 3%. Not just that, it stayed above 3% and keep on rising. And that really gave most of the central bank, not just the federal, the Fed, very nervous. Then what happened here is this orange zone here. Now this is the 30 years high. I hope that you can see my cursor. This is the last 30 years high. This is the last 30 years high. And November 2021, December 2021, January this year, it broke above the 30 years high and it stayed on top of the 30 years high. And that's where 14 December 2021, Fed came and make a statement. It says that inflation is no longer transitory. And you still remember that before 14 December 2021, and the Fed has been making the statement saying that inflation is transitory because of the post-COVID in United States, people get back to job, get back to street, and they shop. Again, it created this inflation. So it's just a short term. But on 14 December, they say that inflation is no longer transitory because I believe they also studied into all this number. I think they start to get a bit nervous that inflation is not coming down to about 3%. So it's been staying on top and stay on top. And I think that is a very responsible statement to make on 14 December. To me, as an investor and traders and also market watcher, it gives me a strong signal that in 2022 and even beyond, inflation is going to continue to rise, and we got to expect that more interest rate hike to come. But again, I'm not trying to paint you a gloom and doom picture, but I'm trying to shift your attention to where is the market to watch that we can have right through this storm and maybe more storm that's coming up. What the market to watch and how to trade them for next session. But for this session, I just want to understand the fundamental. So next session, I'm gonna move you to technical. So we're gonna get into whether we investor or trader. We're gonna find the final point of entry, enter into the gold market. Okay. Now, then of course, what happened then is that from February this year and all the way, all this CPI number, this is the 40 years high. It have broke above and stay above, and that's the real danger. And I don't think that CPI is going to come down anytime soon. Okay. And this one we'll discuss about next week. Why 5.3 is a key number to watch. We'll discuss about next week. I'm going to move into technical reason. Even we're going to find CPI, how to track the CPI. Why 5.3? If it come down below 5.3, then I think we'll be out of danger. Yeah, but haven't come down to 3 yet. Yeah, come down to 3, that'd be great news. How to measure that this CPI have lost its momentum, this upward thrust momentum? It is 5.3. So maybe in the next tutorial that we have, which is 2 weeks from now with Kenanga Futures, I'll explain to you why 5.3. Now let's move on to our next segment here, which is, I think after that we're going to have some time of Q&A. We're going to have quite a few, I think we still have quite a bit of time left. We can move into more time of Q&A. Now, so what's the direction of the interest rate to come? Okay, let's look at here. Okay, so I prepared this. In fact, I prepared this about 2 years ago, but even today still applicable. And this was what I prepared about 2 years ago. And today is even more applicable. Why is it so? And you realize that interest rates still stay at about 0.25%. Okay, so that was 2 years ago I prepared this. And so basically what I'm trying to say here is this. Now notice that heading is that the inverse relationship between interest rate and asset class, the stock market or assets. Yeah. So now as the interest rate trend down, so earlier we studied that interest rate was at a high at about 20% in 1982. It peaked in 1982, and until from then until beginning of this year, beginning of this year 2022, interest rate, the Fed fund rate was about 0.25%. But over the span of 40 years, the interest rate was traveling on a downtrend. And we have to understand that the interest rate trend and with the stock and asset price, assets includes property prices. Okay, so it's inverse opposite. Now, if the interest rate is going to come down, the stocks and asset price going to move up because it's cheap to borrow to buy into companies. It's cheaper to borrow to buy into properties. So that's the reason why in 1980 I was 8 years old, and now I'm 50 years old this year. And in my whole life, I witnessed one thing about assets will always go up. I can tell you about 2 years ago, I have a hard struggle with my wife because my wife wants to buy another property. I say no, because I know what is coming ahead. So we have not an easy few months, but thankfully I managed to convince her not to get into another property where I want to stay clear of debts. But today we're in great relationship. I think she's beginning to see what's happening right now. Now, so what you can see here is the inverse relationship. And now the other thing here is that a lot of market watcher, they say that maybe it could be your banker. I do not know. They say, hey, Mr. Tan or Mr. Wong or Miss Wong or Miss Tan, don't worry that you see in our past when inflation, when interest rate hike, it move up, but the stock market still move up. So don't worry about this interest rate hike. Now, you have to understand that in the past was the last 40 years, it was interest rate was on the downtrend. Yeah, so downtrend, so there's intermittent hike, it is fine because the general trend was a downtrend. But moving forward, my concern is what if this interest rate is transiting from a downtrend of the last 40 years to the next many good years that is moving on the uptrend? And then that will definitely bring a lot of pressure to the asset class, including the stock market and also property market. Yeah. So now again, not a doom and gloom picture at all. In fact, I'm feeling very excited because maybe in the next cycle, I do not know how long it will come. I would love to buy another property, but not now, definitely. I would like to acquire more stocks, but maybe not now. I would like to acquire more Asia stocks. Yeah. But not now. So, but then you may ask me then what is good to trade? Look into the yield market. CME have some yield market. They launched some new product, especially the commodities market. Look at the commodity funds, the ETF, and of course, if you like to trade the commodity. So basically, last year is for stock market, and before last year when stock market is still trending up. So basically, when I trade, I buy on dip. But moving forward, the stock market is that I would like to sell on strength for the micro S&P, micro Nasdaq, micro Russell, and micro Dow Jones. So that's my little tricks here. Moving forward, I'm already doing that. If you've been following me for the last many months, I've been advocating that sell on strength because the trend have changed on the indices. But then where to buy? Where to buy on dips? I will focus on the commodity market and especially for the gold market for long term and short term, both on the gold market and many commodities market. So we are able to take on more Q&A later on. I think we have some time. And so the question is, why is gold not trending higher with inflation? Yeah, so did gold perform much during the last, I would say about last 9 months since that about 8 months or 7 months since that the Federal started to increase interest rate? Most of us will view that gold have not appreciate much. Yes, I kind of agree with you, but if you look at the long-term view, this is a 1 month COMEX gold chart, that you have agreed with me that if I'm going to, next week, I'm going to discover with you about how to draw a primary uptrend line and a secondary uptrend line. Okay, how to draw that. And so basically the gold is still on the uptrend. and there's a primary uptrend line, and that's how I got into the gold position at the beginning of this week because of the US dollar. So we're going to discover, so next next tutorial session that we have, our webinar, is that we're going to discover the technical, more technical aspects about how to enter into the gold market, whether it's for long term or short term. Now, so earlier we discussed about gold is a pair of currency. Now let's look at how I enter the market, the gold market, at the beginning of this week. Okay. Now, so what happened here was last week it was a very volatile week for the dollar because of what the sterling have done. So gold, you could see that it became very technical. Now I could see that there was, if you look back in history, the dollar index over the last span of many weeks, there wasn't any classic inverted hammer. But as a close of last week, as weekend I do my homework, I saw the opportunity that dollar index, I suspect that for the next few weeks to come, it will continue to move down. Yeah. So now my focus, that remember that for gold, I'm already in position. For long-term hold, I'm in. For short-term trade, my focus now is to buy on dips as and when I can. Okay. Now, so when I saw this, that the dollar, this inverted hammer, so I believe that the next few weeks to come, so I prepared this chart this afternoon. Okay, so it measure about from Monday to today. Now, so the next few weeks to come, I believe that the dollar will continue to move down. So then that became a proposition for me to buy into the gold market. And I also see that the gold, as of last week closing, there was a hammer, and it's from about 1680. It went up to about 1740. So just a very quick one before we move into the Q&A, and definitely for next week, the next 2 weeks, the webinar that I'm going to have with Kenanga Futures, I'm going to talk more about technical. So now in the aspects of the most smallest gold contract, because for the gold, what CME they have the standard gold, they have the mini gold, and the micro gold, but I like micro gold because I can trade a few lots, many lots. I feel very shocked about it. Now, micro gold is basically at every 0.01 point, it worth $1. So I just convert it to 1 full point for easier reference for you. So 1 full point, it means that it's $10. So you just shift the decimal, it represents $10. Now, so in the context of if I'm going to purchase at $1,700 of gold right now, what does it represent? So you just take 1,007 times 10. It represents that actually when you buy into a micro gold right now, or you sell short, of course you can do both way, what you're holding in actual cash value or contract value is worth $17,000. So in a reference of 100 points movement, 1,000, you just take 100 times 10 is $1,000. Now let's just go back here. So I make a purchase at 1680, so a 50 points movement like this, just from beginning to the, now is Wednesday. So 50 points movement, that will be $500. So that this is how it works. Okay, so now one thought for you to ponder about is this. So we study about gold is one of the inflation hedge. So there's no question about it. It is not about whether if the gold is going to continue to move higher. To me is when the gold is going to move higher. I think this is just one demonstration here I just given to you. And then now my next question is to you here is a very interesting question, is that since inflation is going to continue to pick up, definitely higher interest rate is in part of the game. So if higher interest rate, so naturally the US dollars will be strengthening, isn't it? Yeah, it's true. But what if a situation of a higher interest rate, could it be a situation where even with a high interest rate, the US dollars is lower? Now that became a thing where we got to watch out, because that became a real danger for the whole market, the asset class, but it became an advantage for the gold. Now, so if this happened, this relationship happened, where inflation is still on the way up, interest rate is still on the way up, but US dollars start to weaken, then I will really double down on my goal. Okay, so now I already established a base for my goal. So if this relationship happen, I will double down my goal, and I expected the goal to accelerate even more. So during the Q&A, you can discuss a bit more on the relationship, but just in the aspects of, if let's say there's quite a bit of Q&A, if we cannot complete on time, then this is a thought for you, and maybe 2 weeks time, the webinar with Kenanga Futures, we can further discuss about this. But for you to sleep through, think about it. What will cause a higher interest rate but a lower US dollars? Is this possible at all? Now, so I just want to give you some homework here. Okay, so before I go to Q&A, I have this Facebook page. The name is Konhow, Konhow, joined together. So every day I'll spend about 1 or 2 hours read news. And since I digest the news, I will summarize it. I'll post on my Facebook so for my followers to enjoy what's my thoughts. And I also post some interesting market behavior as well. So do like or follow it. And then the other one is that the YouTube video tutorial where I received some sponsorship from CME as well. So I've been doing some production on the video tutorial on a weekly basis, and I'll post it on my YouTube as well. And what I've discussed today, I have also packaged it. I'm going to relaunch partial of what we discussed today at about 9:15 p.m. I'm going to launch it later on. So it's a weekly production. So you will learn a lot of things from there in different markets about CME movement. So you can go to my channel, Invest and Trade with Insight. Go and find it, subscribe and hit the bell. So every week I'm going to post a new video tutorial. You will learn a lot of things, including some months ago, I spoke about how to identify the primary and secondary uptrend line. Okay, so which is 2 weeks time, I'm going to discover a few, and also divergence as well. I hope that I can include in that topic for the goal, so that you're able to apply it on your own trading. Okay, so last of all, that's my email. If you find that what I've talk about today is really interesting, you want to email me and share with me your thoughts, go ahead. My email address is konhow@waypedia.com. Okay, so with that, I think I'm quite good with the session, and I'm going to turn this time to Lokman on the Q&A if we have any.